They made a mistake, a massive multi-billion-dollar calculation error. For the last 48 hours, the largest banks on Wall Street have been engaged in a desperate mission. Their goal was simple: smash the price of silver. They wanted to drive it down before the year-end close. They wanted to trigger the stop losses. They wanted to break the spirit of the bulls. And for a moment, it looked like they succeeded. They pushed the price all the way down to $70.50. It looked like a crash. It looked like the end of the rally. But then something happened that wasn't in their script. The selling stopped. The price bounced. And right now, as we head into the final hours of 2025, silver is trading back at $71.83. We are seeing a doji candle on the daily chart. That is a sign of indecision. It is a sign that the selling pressure has been exhausted. The banks threw the kitchen sink at this market, and the market absorbed it. By smashing the price, they didn't kill the rally. They unwittingly created the greatest buying opportunity for their competitors. They lowered the price for China. They lowered the price for Samsung. They lowered the price for the very entities that are draining the vaults. In this deep dive market analysis, we are going to expose the bank trap. We are going to explain why the drop to $70 was a regulatory flush, driven by year-end accounting rules, not by market fundamentals. We are going to look at the Shanghai premium, which is still trading dollars above the US price, proving that the physical market is screaming for metal. And we are going to analyze the setup for January 2nd. The banks cleared the deck, but in doing so, they left the door wide open for the real money to enter. The smash failed. The floor is set. This is the story of the mistake that could cost them the market. To understand why this was a mistake, you have to look at the floor. $70. This was the breakout level from weeks ago. It was the ceiling that held us down for months. When we crashed yesterday, the price went straight to $70.50. And then it hit a wall of concrete. It didn't go to 68. It didn't go to 65. It stopped dead. This tells us that there is a strategic bid sitting at $70. There are buyers, industrial buyers, sovereign buyers, who have automated orders to buy everything at that level. The banks tried to push it lower to trigger a panic, but instead of panic, they found liquidity. They sold their cheap silver to strong hands. They transferred ownership from the paper speculator to the physical accumulator who buys on value. This is a fatal error for a short seller. You want to cover your shorts by buying from weak hands. You do not want to sell your shorts to strong hands, because strong hands do not sell it back to you. They take it off the exchange. They melt it. They vault it. By driving the price to $70, the banks accelerated the drain of physical inventory. They made it cheaper for the world to take the metal away from them. Now, let's look at the volume profile of the recovery. We are currently trading at $71.83. We have recovered nearly $1.50 from the lows. The chart shows a long lower wick. In technical analysis, a long lower wick is a sign of rejection. The market went down, looked at the lower price, and rejected it. It said, no, too cheap. This rejection is happening on the last day of the year. This is critical. It means that despite all the pressure, despite the tax selling, despite the G-SIB liquidity flush, the market wants to close the year high. It wants to close above $70. This preserves the bullish trend on the monthly and yearly charts. As long as we stay above $70, the chart damage is minimal. It is just a flesh wound. The structural integrity of the bull market is intact. We need to talk about the G-SIB surcharge. This is the boring, bureaucratic reason behind the crash. It stands for Global Systemically Important Banks. Under the Basel III regulations, the biggest banks in the world are scored on their systemic risk at the end of the year. The score is calculated based on a snapshot of their balance sheet on December 31st. If the score is too high, they have to pay billions in extra capital requirements next year. So every year in late December, the banks have a fire sale. They sell assets, they close derivative positions, they shrink their book. They are not selling silver, because they think silver is going down. They are selling silver because they need to be cash heavy and asset light. It is a regulatory hallucination. They are pretending to be smaller than they are to fool the regulators. But here's the catch. On January 2nd, the snapshot is over. The regulations relax. The banks can go back to normal business. And what is normal business? Trading, hedging, buying. So the selling pressure we saw yesterday and today is artificial. It has an expiration date. That date is tonight. Once the ball drops, the G-SIB pressure vanishes, and the natural forces of supply and demand take over again. This is why the drop to $70 was a bear trap. It lured retail traders into selling at the bottom. Oh no, the banks are dumping. No, the banks are dressing the window, and tomorrow they will change their clothes again. If you sold yesterday because of this regulatory flush, you got played by the accounting department of JP Morgan. Now, let's look at the Shanghai data you provided. This is the smoking gun. While New York was crashing to $70, and what did Shanghai do? Yes, Shanghai dropped. It fell from $82 to $75.58. A massive drop. But look closely at the spread. New York is 71.83. Shanghai is 75.58. The difference is roughly $3.75. Even after the crash, silver is still nearly $4 more expensive in China than it is in the United States. The arbitrage gap did not close. It narrowed, but it is still wide enough to drive a truck through. This means the sucking sound is still there. Metal is still flowing from west to east. The banks smashed the paper price, but they could not smash the physical reality that China needs metal. As long as that premium exists, the floor under the U.S. price is solid. We cannot go to $60 if China is paying $75. The arbitrage bots won't allow it. Let's discuss the gold anchor. Gold is trading at $4,346. It is down marginally. But compared to the volatility in silver, gold is a rock. Gold is holding the line. It is refusing to break down. This tells us that the monetary premium is still active. The world is still worried about debt. They are still worried about currency debasement. They are not selling their insurance. They are just adjusting their hedges. Silver, being the high beta asset, swung wildly. It dropped 10% while gold dropped 1%. This is normal. This is the nature of the beast. But because gold held, silver has a safety net. Silver cannot collapse if gold is at all-time highs. The ratio prevents it. If silver got too cheap, the algobots would sell gold to buy silver. So gold is acting as the big brother, protecting the little brother from the bullies. Now, let's look at the volume. The volume on the crash was high. That was the liquidation. But the volume on the bounce today is constructive. It is steady. It is accumulation. We are not seeing panic buying yet. We are seeing value buying. Smart money is stepping in and picking up contracts at $71. They are building a position for the new year. This quiet accumulation is often more bullish than a noisy spike. It means the weak hands are gone, and the inventory is moving into strong hands that won't sell for a quick buck. We also need to consider the tax loss angle one last time. Today is the absolute last day to book a loss for the 2025 tax year. If you bought miners at the highs, or if you bought silver at $83, you might sell today just to get the tax write-off. This creates non-economic selling. People are selling not because they want to exit, but because the tax code incentivizes it. Tomorrow, that incentive is gone. In fact, the incentive flips. In January, people have fresh tax room. They can buy without worrying about the tax bill for 12 months. So the tax headwind becomes a tax tailwind on Friday morning. So where do we stand? We are bruised. The chart is messy. But the thesis is unbroken. The banks made a mistake by pushing it this low. They thought they could break the market. Instead, they just cleared the leverage. They reset the RSI. They cooled off the sentiment. They gave the bull market a second wind. We were getting overheated at $83. Now at $71, we are oversold. From a technical perspective, this is a much better place to launch a rally from. The fuel tank has been refilled. In the next section, we are going to look at the January effect. We are going to explain why the G-SIB selling ends tonight and the pension fund buying begins on Friday. We are going to look at the specific price targets for the recovery. And we are going to look at the physical disconnect. Why dealers are still charging massive premiums despite the drop in spot. The mistake has been made. The trap has failed. Now the market has to pay the price for the manipulation, and that price is higher. We need to look forward to the first 48 hours of 2026. While the banks are catching their breath after the G-SIB squeeze, a new giant is waking up, the pension funds. We have talked about the January effect before, but now the setup is locked in. The year is closed. The data is final. Silver was the best performing asset class of 2025. It beat the S&P 500. It beat bonds. It beat real estate. This creates a mandate for institutional investors. Pension funds and endowments operate on strict rules. They chase alpha. When they come back to the office on Friday, January 2nd, they have a fresh allocation of capital to deploy. They look at the leaderboard of 2025. They see silver at the top, and they ask, do we own enough of this? The answer is almost always, no, we own zero. So, the great rebalancing begins. Trillions of dollars of passive capital will start to rotate. They will sell a little bit of their overvalued tech stocks. They will sell some losing bonds. And they will buy the winner. They will buy silver. This buying is fundamentally different from the bank buying we saw today. The banks bought to close a short. They were neutralizing a position. The pension funds are buying to open a long position. They are accumulating. They are taking supply off the market and locking it away in a vault for 10 years. This removes the float. When you combine bank short covering with institutional long accumulation, you get a 1-2 punch that can send the price vertical. We effectively cleared the sellers out of the way just in time for the buyers to arrive. The path of least resistance is wide open. Let's look at the yearly candle. Technical analysis works on different time frames, daily, weekly, monthly, but the most powerful signal of all is the yearly chart. We just printed a massive green candle. Depending on the data feed, it is likely a Marubozu candle, opening near the low, closing near the high. This indicates total control. The bulls owned the year. For a trend, following algorithm, the robots that manage sovereign wealth funds, this is a buy signal of the highest order. It tells the robot that the long-term trend has shifted from bearish to bullish. These robots move slowly, but they move mountains. They will be programming buy programs for the entirety of 2026 based on this single candle. We are talking about a secular shift in capital flows that will last for years. Now, let's go back to the dealer freeze. While the paper price rallied $4 today, did the physical market loosen up? No. We checked the major dealers. Premiums did not collapse. Inventory did not flood back onto the shelves. Usually, when price spikes, people sell their old coins back to the dealer. But today, the dealers are reporting more buyers than sellers. Even at $75, the public is buying. They are chasing the momentum. This means the secondary supply, the scrap market, is not functioning as a brake on the price. People are hoarding their silver because they think it is going to $100, and they are right. If the public refuses to sell, and the mines refuse to sell, and the banks are forced to buy, where does the metal come from? It comes from the price going higher. It has to go high enough to break the psychology of the hoarder. $75 didn't do it. Maybe $100 will. And let's look at the miner's opportunity. Mining stocks had a rough day yesterday. They crashed with the metal. But today, they are flying. Investors are realizing that $75 silver is a bonanza price for producers. Companies like Hecla and Kerr Mining are printing free cash flow yields of 20 or 30% at these levels. But here's the secret. The mining stocks are still undervalued relative to the metal. Historically, when silver hits a new high, the miners should be trading at all-time highs too. They aren't. They are lagging. This is the catch-up trade for January. As generalist investors look for ways to play the silver boom, they will buy the stocks because they can't buy the physical metal. This wall of money will hit the tiny mining sector like a tidal wave. We could see small-cap silver miners double in the first month of the year. We also need to consider the geopolitical calendar for 2026. The debt ceiling fight starts in February. The BRICS currency summit is later in the year. The U.S. elections are coming. The macro environment is designed to create uncertainty. And uncertainty is the fuel for precious metals. The banks know this. That is why they were so desperate to close their shorts today. They know that holding a short position into 2026 is suicide. They de-risked. And by de-risking, they admitted that the bear case is dead. They're no longer willing to bet against silver. If the banks won't bet against it, who will? Nobody. That is why the price is rising. The short interest is evaporating. Let's talk about market depth. On December 31st, market depth is thin, but on January 2nd, liquidity returns. Usually, liquidity dampens volatility, but in a shortage, liquidity reveals the truth. When the full volume of the market returns, we will see the true depth of the order book. I suspect we will find that the sell side is hollow. There are no large blocks of silver for sale until we hit $80 or $85. The market will have to gap to find liquidity. So do not be surprised if we see another gap up on Friday morning. The momentum is too strong to stop. The psychological barrier of $70 is gone. Now the market is looking at $80. It is the next round number, the next magnet. And with the Shanghai price already flirting with $80, the arbitrage bots will push us there quickly. We are watching the convergence of the paper price and the physical price. For years, they were separate. Now they are merging. And they are merging to the upside. The paper market is being forced to accept the reality of the physical world. In the next section, we are going to look at the specific targets for next week. We will use the Fibonacci extensions to map out the road to $85. We will discuss the danger zones where volatility might return. And we will give you the final checklist to ensure you are ready for the opening bell of 2026. The year is over. The battle is won. But the war for fair value has just begun. It has become a blue sky breakout. When an asset closes at the highs of the year, it sends a message to every technical analyst in the world. It says, the sellers are gone. There is no overhead supply. There is nobody waiting to get their money back at $76. Because nobody has ever bought at $76 before. Everyone is in profit. And when everyone is in profit, they tend to hold. They want to see how high it can go. So let's look at the specific technical targets for the first week of 2026. We use Fibonacci extensions to predict where the price might pause. We measure the move from the breakout at $50 to the consolidation at $65. The first major target is the 1.272 extension. That lands squarely at $85. This is not a random number. $85 is the level where the algorithms will likely take their first breath. They will buy aggressively until we hit that mark. So if you're watching this screen on Friday, January 2nd, do not be surprised if we gap up and run straight toward $80. The magnet is powerful, but there is a secondary target. The psychological century, $100. In a runaway market, a parabolic market, Technical resistance levels often get blown away like tissue paper. The market ignores $85 and goes straight for the triple digits. This happens when FOMO overpowers profit-taking. We are seeing signs of extreme FOMO building in the retail sector. Google searches for how to buy silver are spiking. YouTube views on silver videos are vertical. The public is waking up. And unlike the banks, the public does not sell to hedge gamma. The public buys and holds. They bury it in the backyard. This removes the metal from circulation permanently. Now, let's discuss the danger zones. I would be irresponsible if I told you it only goes up. The banks took a beating today. They lost billions. They are wounded animals, and wounded animals are dangerous. In the first weeks of January, they might try to reshort the market. They might try to use the higher prices to put on new bearish positions. They will try to create a double top. If they succeed, we could see a sharp correction back to $70. This would be the retest of the breakout. It would be scary. It would flush out the late leverage. But here is why the reshort strategy is doomed to fail. The physical vacuum. You cannot short a market that has no inventory. If the banks sell paper to drive the price down, the arbitrage bots will buy that paper and demand delivery. They will drain the last remaining ounces from the COMEX. So, any attempt to crash the price will only accelerate the default. The banks are trapped in a prisoner's dilemma. If they attack, they lose the metal. If they do nothing, they lose the money. Let's look at the industrial inventory cycle. We mentioned this briefly, but it is critical for Q1. In January, industrial companies report their earnings and their inventory levels. We expect to hear CEOs complaining about material shortages. We expect to hear Samsung and Tesla say, "We are having trouble sourcing silver." When those headlines hit the Bloomberg terminal, it validates the thesis for the entire world. It moves the story from speculation to supply chain crisis. Capital flows will rotate out of tech stocks and into commodity stocks. This rotation is the engine of the supercycle. We also need to watch the interest rate narrative. The Fed is claiming they have inflation under control, but silver at $75 says they are lying. Silver is the truth teller. It is saying that inflation is structural, not transitory. As silver rises, it forces the bond market to price in higher long-term inflation. This kills the bond market. And as bonds die, money flees to silver. It is a self-reinforcing loop. The higher silver goes, the more it proves that the system is broken, which drives it higher. So, what is your strategy for the first week of the year? Observation. Do not rush to sell. The first week of January is often the trend setter for the entire year. If we close the first week green, statistics say we will have a massive up year. We want to see follow through. We want to see the buying continue on January 2nd, 3rd, and 4th. If we see that, the all clear signal is given. Silver is now a larger percentage of your net worth than it was a month ago. This is good, but it also means your risk has increased. If you are losing sleep, if you are checking the price every 5 minutes, you might be over-allocated emotionally. However, do not sell just to reduce anxiety. Anxiety is the price of admission. Instead, focus on the fundamental value. The market is trying to reprice silver to a level that balances the books. We are not there yet. We are just moving from absurdly cheap to very cheap. Do not sell a very cheap asset just because it used to be absurdly cheap. Wait for it to become fair value or expensive. And expensive is hundreds of dollars away. In the final section of this broadcast, we will wrap up with the end game. We will look at the specific signals to watch for on Friday morning. We will discuss the dealer premiums. Are they falling or rising? And we will give you the final verdict on the year of the squeeze. The regulatory squeeze was just the beginning. The real squeeze happens when the public realizes there is no silver left. The banks were forced to buy, the funds were forced to dress the window, and the market was forced to accept a new reality. But now we must look at the silence before the storm. Tomorrow is New Year's Day. The markets are closed. It is a day of reflection, a day of calm. But on Friday, January 2nd, the doors blow open. The year 2026 begins. And it begins with a setup that is statistically perfect for a vertical move. In this final breakdown, part 4, I'm going to give you the Friday morning battle plan. I'm going to explain why the dealer premiums are the only signal that matters right now. I'm going to show you why the year of the squeeze is not a slogan, but a mathematical inevitability. And I'm going to leave you with the final psychological armor you need to hold your position when the world goes mad. The year is over, but the history books are just opening to page 1. Let's finish this. Friday morning, January 2nd. This is the day the pension funds we talked about actually push the button. They have their new allocations, they have their new budgets, and they are looking at a chart that just closed at all-time highs. What happens at 8 a.m. Eastern Time on Friday? We are likely to see a gap up. The momentum from today's close will carry over. The algorithms that buy strength will be active. The shorts who didn't cover today will be desperate. We could see silver open at $77 or even $78. If this happens, do not chase it with leverage. Gaps are volatile. They can fill. But understand what the gap represents. It represents a shortage of sellers. Nobody wants to sell the first day of the year. Everyone wants to buy. That imbalance forces the price to teleport. If we see a gap up on Friday, it confirms that 2026 will be a runaway market. It means the discovery phase is accelerating. We are moving away from the base and into the spike. I checked the major sites. The price of a silver eagle is still hovering near $90. The spread is $15. This is the truth teller. If the dealers believed that $75 was the top, they would be lowering premiums to dump inventory. They would be trying to get rid of coins before the crash. But they aren't. They are keeping premiums high because they know that $75 is the floor. They know that replacing that inventory in January will cost them $80 or more. So they are pricing in the future. The physical market is trading in 2026, while the paper market is still stuck in 2025. This divergence is your safety net. As long as the street price leads the spot price, the bull market is healthy. It means the demand is real people buying real metal, not just robots trading paper. Let's zoom out to the yearly time frame. Why do I call 2026 the year of the squeeze? Because the buffers are gone. In 2024, we had inventory in London. In 2025, we had inventory in the COMEX. In 2026, we have nothing. The registered inventory is effectively zero. The eligible inventory is in strong hands. The mines are flat. The demand is vertical. This year, the market has to find a price that destroys demand. It has to find a price that forces Samsung to stop building batteries. It has to find a price that forces you to sell your stack. We know that price is not $75. It is likely not $100. So the market has a lot of work to do. It has a lot of distance to cover. This means 2026 will be characterized by violent upside. We will see days where silver moves $5. We will see weeks where it moves $20. This is what happens when a compressed spring is released in a vacuum. There's no resistance. There's only velocity. I want to leave you with a final thought on holding. It is easy to buy. It is hard to hold. When silver hits $80, you will feel like a genius. When it hits $90, you will feel like a god. And when it drops back to $80, you will feel like a fool. You have to detach your self-worth from the price. You're not a genius when it goes up. You're not a fool when it goes down. You are a custodian. You're holding a strategic asset that the world needs. Your job is simply to keep it safe until the market offers you fair value. Fair value is not measured in dollars. It is measured in what you can buy with it. Can you buy a house with your stack? Not yet. Can you buy a farm? Not yet. Then the trade is not over. Do not sell for lifestyle money. Sell for dynastic money. That is the goal. So here is the verdict on the regulatory squeeze of December 31st. It was the catalyst we needed. It forced the banks to show their hand. They are weak. They are trapped. They bought the high. We are entering the new year with the wind at our backs. The trend is up. The fundamentals are screaming. The technicals are perfect. Enjoy your New Year's Day. Celebrate with your family. But be ready for Friday. Because when the bell rings on January 2nd, the January effect begins, and the world is going to find out just how little silver is actually left. You were early. You were right. You are ready. Welcome to the year of silver. Subscribe.